Welcome to another episode of Coffee and Coin. I've got Whitby back on the pod today. Hey, Whit.
Hi, Allegra. Hi, listeners.
Where in the world is Whitney, San Diego? That's
Hi.
the little jingle I have for her because if you don't know, Whitney has been on now we're going on a multi-year sabbatical, and she travels endlessly with her husband and lives a very cool life. So where are you podcasting in from today?
I am podcasting from Copenhagen today.
Love it. So, okay, today's episode is all about index funds, particularly how to select index funds. So, we wanted to record this episode because index funds are very popular, and yet they're a little misunderstood. People throw around the term, but they're not really sure what they are, how they're comprised, why they're beneficial, how they have to do with asset allocation, and really how to make a selection so that you can own an index fund in your portfolio or many. So that's what we're going to get into today. You ready, Whit?
Let's do it. Let's get into it.
All right. Well, let's just go ahead and start with the obvious. What are index funds? Can you define them for us?
Yes, absolutely. So, index funds are a type of investment that you can buy on the stock market that packages up a mix of stocks and bonds with the whole goal of matching the performance of its benchmark or its index. So, a good comparison is like meal delivery services, something like HelloFresh or Blue Apron, where instead of having to go to the grocery store and select each individual ingredient, which is tedious, time consuming, could be risky because you can grab the wrong thing, you can just order one package and all of the ingredients will be included for you.
I don't know why that just reminded me of this embarrassing moment, but I remember trying to get the ingredients to bake a cake at the grocery store, and I couldn't find where the heavy cream was. I just assumed it would be in the baking aisle. Like, I had no idea it would be refrigerated somewhere else. So I really like that analogy because obviously it can be overwhelming and a little daunting to pick out so many things especially when you're getting started investing, right? So I love the idea of you just pick the meal and the ingredients are already ready for you. So let's get into the benefits of index funds. Why are they so popular? What are the benefits of having index funds in your investment portfolio?
Number one is the diversification. We kind of already talked about the ease, but the diversification of index funds, because when you buy one index fund, you are actually buying into multiple companies and organizations. Whereas, if you're buying individual stocks and bonds on their own, it's exactly like we just talked about going to the grocery store and picking out your own ingredients. It can actually be rather risky because you're really just making a few bets on specific companies to provide all of your returns. So you're going to be highly susceptible to, any new government regulations in that industry, any other industry headwinds. So with index funds, you're really getting that broad market exposure, which is going to balance out your risk.
So when you're talking about diversification and not having to be responsible for individual selections of stocks, which is you picking companies, which if you are going to be picking these, you obviously need to be researching them and doing a lot of work to understand the company financials, the company plan trajectory, which is never going to, fully turn out that way as life happens. So I guess I'd want to understand, just for reference, instead of having to pick out these individual stocks on your own and research all those companies and how many, like how many would you be able to even do and keep up with? What are the number of stocks and bonds you might find inside of an index fund?
Oh, good question. So we're talking hundreds, even thousands. which if you're going to be picking out hundreds of thousands of, stocks and bonds on your own, let's go back to that that time factor and all that research you have to do. So again, the index fund does all the work for you. You pick one index fund and you have exposure to hundreds or thousands of different companies to balance out your risk.
Yeah. And I think that time is something we talk about so much at Factora because women who are taking the Well Circle are seeking financial freedom, but another way to define financial freedom is time freedom, right? So you wouldn't want to be spending all day trying to keep up with thousands of stocks because you've invested in thousands of companies individually. This is a way to do it very seamlessly and without taking up a lot of time. Okay, so diversification is clearly a great benefit of index funds. Is there anything else?
Another huge benefit is that they are cheap. Since they are designed to just match the market performance, this is known as a passively managed investment style. So there's not an active team of portfolio managers making trades to try and beat the market. So the operating costs for index funds are very low. And the cost to you to look for is expense ratio. That is how much it will cost the investor to buy the fund. So these expense ratios for index funds are very low compared to actively managed mutual funds.
Okay, so that was helpful that you described the name of the other type. So when we're talking index funds, we're talking passively managed. There's no team of individuals back there, which means they're not passing that cost on to you in a higher expense ratio. The cost to the purchaser of owning that type of fund. Whereas with mutual funds, they do have an active management team. And so that's why they have to be more expensive.
Exactly. And I don't want our listeners to get confused because some index funds will have the name, something index mutual fund. As long as it says the word index in there, it's an index fund. And you can always tell if it's passively managed by its expense ratio. If it's low, it's going to be passively managed. If it's a high expense ratio, it's going to be actively managed.
Okay. Well, I guess my last question there is just to solidify this for listeners. With mutual fund management teams trying to beat the market, if there aren't really a team of people running an index fund, how can they claim to do what they do by keeping pace with the market?
There still is a team of real people, of real, portfolio managers behind index funds, just not as many. And they're not going to need to dedicate as much time to running the fund since they're not trying to beat the market. So that's essentially why the cost of operating index funds is much lower.
So I think that this is kind of the first time I'm really realizing it this way. But obviously, we love to talk about funds at Factora so that women don't have to go out and do all that work on their own. But in between you DIYing an investment portfolio by picking everything or selecting index funds that are just trying to keep up with whatever index they're against, is kind of that middle ground of mutual funds where it's like managers doing it for you, which is why it's going to be more expensive. But there's also no guarantee on how they'll perform because at the end of the day, it's still humans making all these selections. It's just more dedicated in this industry with experienced humans rather than the individual retail investors. And retail investors is just another term for us, you and me. We're retail investors. We're not institutional or expert investors living day in, day out in all of these company reports.
Yep.
All right. So let's move on to what steps do you need to take before being able to purchase an index fund?
So in order to purchase an index fund, there are a few things that lead up to it. You can't just, roll out of bed one morning and say, I'm just going to buy a fund instantly. Step one is you're going to need to select your brokerage firm. So this will be the financial institution that holds your investment account. So some of the most popular brokerage firms at Factora are Charles Schwab, Fidelity, Vanguard. So once you select your brokerage firm, you then are going to need to open up an investment account. Now, there are different kinds of investment accounts, all pertaining to the way your investments will be taxed. So there's tax advantage and there's taxable accounts. We get much, much deeper into the various kinds of investment accounts in the Wealth Circle. We're not going to go over them today on this podcast, but if you're at that step, definitely do your research to know which investment account to open in which you will put your index fund inside of. So then step 3 would be to fund your account. You can't buy an index fund without money. So you're going to need to put money into your account. And when you do, it will be held in cash. It will be held in likely a money market fund. Now, the biggest mistake you can make is just leaving your money in cash in your investment account, because then it becomes a glorified bank account. You are going to want to then move that cash to an index fund. But before you can do that, step 4 is you really, really have to understand your risk tolerance. This is such an important step in selecting index funds because it's going to influence which index funds you're going to want to select for your portfolio. So there's a range, right? There's funds that are more aggressive. That means they're going to invest heavier in stocks. And there's funds that are more conservative. They're going to invest heavier in bonds. And there's the whole spectrum in between of moderate, having moderate risk tolerance, moderate aggressive, moderate conservative. So you're really going to want to understand your personal risk tolerance.
Well, if I was a listener, I would then want to understand what the heck is risk tolerance? Like, what does that mean? How do I know I'm moderate conservative or just very aggressive?
Yeah. Okay. So to break down risk tolerance, it's really the degree of loss within your portfolio that you are able to stomach. So how would you feel if your portfolio lost 20% in 1 month or even 20% in 1 week? High risk and low risk investors are obviously going to have very, very different answers to those questions.
Totally. And I think it's important to note that all investing involves some level of risk. That's really the definition of investing. You are putting your capital at risk for the potential reward of a return on that money. So, this is a really important step. We focus on giving you different resources inside the Wealth Circle so that you can go and determine your risk tolerance. But for listeners, how can they do that? How can they figure out what their risk tolerance is to even get started?
Yeah, so your risk tolerance is really going to depend on factors like your age, your income, your financial situation, your goals, your desire for thrill. So this is definitely something we get deep into in the Wealth Circle, but a real easy way to just kind of assess your risk is to take one of those free risk assessment questionnaires online. Like tons of brokerage firms offer them for free. I've been using the one from Schwab, MLNR Wealth Management, Mass Mutual, but you could really just do a simple Google search and find a risk assessment questionnaire online. And what it will do is walk you through a series of questions, and then it will assign points for each one of your answers. So at the end, you add up your points, and it's going to suggest a certain asset allocation for you. That I will have to say is a good starting point it is not necessarily recommended that you take one questionnaire and say, okay, the points told me I am an aggressive moderate investor, so that's what I am. It's a starting point. So take that and, add in things like your age, how long you have to retirement, how many liabilities you have, how risky you can afford to be, how risky you like to be, and then you can adjust your asset allocation from there.
As we're sitting here talking, I'm just realizing how important it is to discuss this with someone. It's really hard to just sit online and take risk assessments, or the way I started with investing, get on investopedia.com and read about the terminology I didn't understand and go from that to doing it. So I think that's why we're so obsessed with community around money, right? So you and I can talk about our risk profiles and how they are currently and how they might change and what we're adding to our portfolio and what we're transitioning out of. Because I guess my next question is, even if you were to find your perfect risk tolerance, does that stay your risk tolerance forever, or does it change?
I mean, like anything in investing, it should never stay stagnant. So your risk tolerance is you're gonna want to change it over time. Younger investors, since they have a long runway to invest, more opportunity to ride out any short-term volatility, more opportunity to gain returns before they retire, they are going to want to have a more aggressive asset allocation. As you get older, closer to retirement, closer to the age you're going to start withdrawing from your portfolio, you're going to want to shift that allocation more conservative, because then your strategy becomes wealth preservation rather than wealth building.
I love that slide we have that's like the first part of your life, it's all about wealth accumulation, and then you transition into wealth preservation. This is where you really do have to be your own risk tolerance advocate. Generally, you this is why it's so important for women to understand investing, right? Because there is no perfect way to invest. It's personal based on your financial situation and your goals and desires. And then it is going to change over time as you maybe add to your family, as you have more liabilities, more responsibilities. And like Whitney said, as you age, you obviously want to be more conservative generally, because this pot of investments that you've been building up, your portfolio, you can take a lot more risks when you're younger, and you want to be a lot more thoughtful when you're older and you need to draw from it. So let's talk about once you know your risk tolerance.
I want to go back real quick about the age
Okay.
and investing, because it's such a big question we get in the wealth circle, because it's like, am, am I getting old? Should I start, moving my investments to more conservative investments? So I'll use myself as an example. I'm 37 years old, and believe it or not, that is still young in the investment world. So my strategy is going to be, as of right now, capture as many long-term gains as possible. So I recognize and accept that that means that I'm going to feel the short-term volatility along the way, because at 37, I have such a long runway to invest that when I took the risk assessment questionnaires, it was recommended to me to stay somewhere between 90% and 100% in stocks. I've chosen to be 100% in stocks for now. But somewhere between ages 40 and 45, I'm not going to want to feel all that short-term volatility anymore. I want to start preserving some of my gains. So I will be moving my investments more conservatively. And I haven't decided if I'm going to just do that at 45 or a slow progression between 40 and 45. But by 45, I want to have about 15% in bond positions. So moving 15% of my portfolio more conservatively.
I'm really glad you took us back because I think it's important to use ourselves as examples always. That's why I'm so candid about my portfolio, my money, my goals, because I want other women to feel comfortable doing it too. And I'm similar to Whitney in age. I'm 36, but I have only 90% in stocks. I have 10% in bonds currently, and our financial lives are different. I have a young daughter. I'm planning on having more kids. I do feel like I'm an aggressive investor with 90% stocks. And I also recognize that, we're in different phases of our life. Like I'm very much home building a family, and Whitney's out, you know, conquering the world. But we're also only talking about us, and we both have household finances and partners with, varying degrees of their risk profiles that are involved. And so that is why it really is just so individual.
And in talking, the interesting thing is I always considered myself a more conservative investor. And, going back to the point about just like having a community, an investment community of women to talk to, even about little things like asset allocation. I remember talking to you, Allegra, years ago, and I kept saying, I'm just a very conservative investor. And you kept telling me, I don't think you are. I mean, are you sure you're conservative? So I have just learned more about my investing self through having these kinds of conversations with you and with other women in our community.
Well, actually, listeners, she didn't just say she was a conservative investor. You thought of yourself as a very conservative person, which was so interesting to me because you worked at a startup that was big, albeit, and more solidified, but still startup, venture backed. And then you came to work for this startup that was not venture backed, that was very early on. You were basically the second employee. And now you're traveling the world with no real foothold at home. So people would listen to you and think, this is not a conservative woman. This is a risk taker, which I love because I think that life is all about risk. Literally, we have to make decisions on a daily basis without all of the information at our fingertips. That's kind of the point. The only constant is change and figuring out what we want to do or how we want to handle obstacles that come our way. And so it is so interesting getting to talk to women all the time about investing because investing is putting your capital at risk. But there's such a reward for it. I mean, you've been investing since you were 21 and you have $1 million portfolio because you have been extremely focused on continuous investing. And a lot of that has been through paper assets, which is really just the terminology we use for stock market investing.
Yep. I mean, even though I haven't hit financial freedom yet, I have financial flexibility, thanks to my portfolio gains and my diligent stock market investing. So even before financial freedom, hopefully this is an encouragement to to investors out there. You can reap the rewards of your portfolio, which is what I'm doing now, where I'm not contributing much to my portfolio right now, but I'm also preserving it and keeping it compounding. So I'm not withdrawing from it either.
And she is practiced in her ability to handle volatility, which is why you're able to have that aggressive risk tolerance still. Like you're not maybe contributing, but you are able to see fluctuation and not be spooked by it,
Yeah.
which is impressive. And I love that you brought up financial flexibility because there's so much flexibility on the way to freedom as long as you have assets. And investments are assets, right? And we love the assets that can bring us passive returns, passive additional income streams outside of a job. So I don't want to get too off topic. I want to bring us back to once we understand our risk tolerance, what happens next on the way to selecting index funds?
All right. Thanks for getting us back on track. Okay. So once you have determined your risk tolerance, it's the best part. It's time to pick your funds. Now, this should actually be pretty easy. It's one of the most simple steps in the process because there truly isn't a best index fund. They're all trying to do the same thing, which is mirror the market. So what you need to keep in mind rather than which, one should I pick is which index funds are going to match my intended asset allocation and my risk tolerance. And then which funds have low expense ratios. So there'll be a whole bunch of fund data available to you on your brokerage platform. You'll see all these charts and graphs and performance numbers like assets under management, inception date, the benchmark. I mean, a whole bunch of information, but time and time again, the expense ratio is the most proven predictor of future fund returns. So you really can just focus on that one number when selecting your index fund.
And just as a reminder, what is the expense ratio again?
So expense ratio is the cost to you, the investor, to buy the fund. So when I say low expense ratio for passively managed index funds, I'm talking anything, under 0.2%.
And how might that compare to a mutual fund's expense ratio?
Mutual funds expense ratio can be sometimes north of 1%. That's when you want to run the other direction because that percentage is eating into your investment return.
And it's compounding, right? So we have some great graphs on this. Hopefully, I won't misquote them, but it's something like a 1% expense ratio compounded over time is going to eat away like a quarter of your potential investment returns over 40 years.
Yep.
So if you would have walked away with a $4 million portfolio, you're really only walking away with 3 because 25% went away, even though it seemed like it was just 1%, but it compounds. So we always want compounding to work for us, not against us. I do want to be clear though, we're not saying that you can't or shouldn't have mutual funds. We're just trying to help you understand the difference in a low expense ratio versus a high expense ratio. And all investors need to be really aware of their investment costs.
Just to go back to the benefits we discussed at the beginning of the episode, for just 0.2%, you are buying into hundreds or even thousands of different investments, different companies. That is great diversification for a very good price.
Totally. So we're here. We are selecting our funds based on our risk tolerance. How many funds should I get?
Okay, here's the motto of selecting index funds. Do not overdo it. 1 to 3 index funds is enough because remember, they have tons of different investments inside of them. So depending on your risk tolerance, in some cases, it makes sense to allocate your entire portfolio just to one total stock market index fund. So this means you'll be 100% invested in UX stocks. If that's what your allocation suggests, then potentially just one index fund will be good enough in your portfolio. Now, those who want more international exposure for geographic diversification can also consider adding an international stock fund to their portfolio. Keep in mind that, international investing comes with more risk because you're going to be exposed to currency and political factors. So just make sure you're comfortable with that before buying any international funds. But like, for instance, I am an aggressive investor and I don't like to allocate my portfolio to more than 35% of international stocks because of the risk. But I also want to say there's a whole world out there. There's tons of great international opportunity. So that is an option to take a look at. And then, of course, just to balance out your portfolio, if you're a more conservative investor, take a look at total bond funds for your portfolio. And as you age, you're going to want to increase the amount of investments you have in bond funds. So I like to really start with the approach if you're a new investor. If anyone follows Personal Finance Club, he really hammers this home. But the three fund approach of allocating your portfolio between US stocks, international stocks, and bonds. And then how you allocate your portfolio, the actual percentages you put into those three categories, that is your asset allocation. Now, as you advance your strategy, you can take a look at some additional categories of stocks and bonds like small cap, large cap, growth, value, emerging markets. We definitely discussed this in the Wealth Circle. It's a little too much to discuss on this podcast episode, but just know that you can always expand your asset allocation and your portfolio from there.
Yeah, and I was just thinking, I opened up my portfolio real quickly to see if I should share some of what I have inside because I always love to be candid. Mine are even sector specific, but you have to remember I've been doing this for a while. So I have, for instance, um, Vanguard Healthcare Index Fund, Vanguard Materials Index Fund, Vanguard Utilities Index Fund. And then, of course, I have a lot of exposure with the Vanguard Total Stock Market Index Fund. The other thing I have are some ETFs, and I just wonder if we shouldn't quickly tell people what ETFs are because those come up a lot of times when people are hearing index funds.
Yes, yes, yes. Okay. I'm glad you brought this up. So ETF stands for Exchange Traded Fund. It is very, very similar to an index fund. It's passively managed. It's aimed to mirror the market or a particular industry. And it, for beginners, I don't want to overcomplicate it. So I want to just say it is virtually the same thing as an index fund, but there's some nuances in how they're traded, where index funds can only be purchased once at the end of the trading day. Exchange traded funds or ETFs, they can be purchased in real time throughout the trading day. So the goal of index funds and ETFs are virtually the same. They're both low cost, they're both passively managed, but there are some nuances in how they're taxed and how they're traded.
I think that was really helpful. Both are great is basically our point. Okay, then there's one more fund that comes up a lot, especially in the Wealth Circle, when women are digging into their 401ks, which is one of, well, not just their 401ks, any retirement accounts they have. They might have individual retirement accounts, which is an IRA, before they come into the Wealth Circle. And part of their assignment is to figure out what investment selections they've already made within those accounts. Now, one of the first things we see, which is horrible, and I always hate bringing this up, but you mentioned it earlier, is that oftentimes they have cash sitting in those accounts because they funded the investment account with money so that they could purchase investment selections, and then they didn't actually make investment selections, or they didn't make enough, so they still have a high majority of cash sitting in there. And those cash accounts can sound like investments, which is even more confusing. But again, once you really understand this, you won't make the mistake again. But the other thing a lot of women have access to and utilize are target date funds. So before we wrap up this episode, I just want you to explain what those are, and are those index funds?
So target date funds are a little unique because they are funds of funds, meaning they are a fund that is made up of different index funds. So where index funds are made up of different stocks and bonds, target date funds are made up of different index funds. So the target date fund is essentially trying to create that 3-fund portfolio for you. So it's making it even easier for you to get diversified, in the market. So when you invest in a target date fund, you really only need to invest in that one fund. And I'm talking your whole life. You'll be completely diversified, and then the fund will automatically shift its allocation to be more conservative as you age, as you approach retirement. So it's truly a set it and forget it approach. And honestly, you will be over diversified if you invest in a target date fund and then you're trying to mix in all these other index funds because they've done the work for you. So again, don't overcomplicate it. But the way that you can identify these target date funds is that in their name, they will have their planned retirement year. So if I'm looking to retire in 2045, then the target date fund I would want to invest in would have 2045 in its name. So that's how you can easily identify them. Now, one call out is that you're going to pay a bit of a premium for these funds because they're doing a lot of extra work for you. So the average expense ratio for target date funds is about 0.5%. I'd want to look for anything, lower than that. But again, that's still pretty cheap, especially for all the diversification and the asset allocation shift that you're automatically getting in those funds.
And the convenience, right? If
Yes.
you're listening to this episode and you're thinking, "Oh, okay, I've got the basic layout for how to select index funds, but to come up with the right 3 on my own and get it done," if that feels a little too complex, then a target date fund is a great option for you. So you're paying that premium, but you're paying it for convenience. The other thing I'll say, because I can't help myself, is there are so many women in the Factora community who we really emphasize just getting started. You can transition any of this as you go, and there is absolutely no alternative to your personal experience. You got to do it in order to get better and more comfortable at it. 6 years ago, investing was so scary for me. And I remember putting my first $250 into a brokerage account and thinking it was going to be gone the next day. And instead, I checked on it and it gained like a penny. Now I'm in such a different place. I have a big portfolio, a lot of assets, a lot of these different funds, and I'm constantly, well, I'm actually not that often looking at it. I really don't look at my paper assets very often because I don't plan on taking them out for such a long time period that if anything, I love to check on them every few months because I've got my automations on, I have my selections made, my automations are going into those different funds that I want to add to on a monthly basis. And then it's so delightful every quarter when I look in and make sure things are properly balanced and boom, there's additional money because I've been adding and hopefully the market has been doing its job and performing. Now, it's not always going to do that, right? We've seen some crazy volatility since the pandemic occurred. But this is why you need to understand these fundamentals and just get doing it. So once you do it, you can transition your strategy. You can go from, oh, I've got this target date fund that has the 3-fund portfolio for me to, I think I actually want to make some selections for myself. And then you can transition into that. Or you can leave your target date fund until your retirement year. And that's a great option too. The point is that you should understand all of your investments and feel comfortable and confident that they're the right ones for you.
Yep. And you can have different approaches for your different accounts. I mean, you can take the
Yes.
target date fund approach for your 401k or 403b and then do the 3-fund, index fund approach in your taxable brokerage account.
Yeah, and you can even have multiple taxable brokerage accounts for different purposes, right? You might want to have one that's got a 15-year time horizon and another that's got a 30-year time horizon, and you've got different investment approaches to both of those.
Absolutely.
Okay, well, I don't want to overcomplicate things. I think this was a great episode. Whitby, thank you for breaking down how to buy index funds. Listeners, if you liked this topic or you want other different investment breakdowns, let us know on Instagram, or you can always write to us at info@factorawealth.com. Thanks, Whitney.
Thank you. Talk to you later.
Bye. If you enjoyed this episode, come join us in a Wealth Circle. It's our live, online, 12-week course and community where we teach you how to create a personalized financial plan alongside hundreds of other women building wealth. It will change your life and your money for good. You can apply at factorawealth.com/wealth circle. That's factorawealth.com/wealth circle. See you in the next episode.